Now that all the stock market indexes have sold off dramatically and bounced in a pretty spectacular way, everybody's asking, is the bottom in? The problem with any market bottom is it doesn't happen in a way where somebody rings a bell. The only way you know if you've hit a market bottom is after days, weeks, or even months later when the price action shows you that that was as low as the stock market was going to go. The other problem with bottoms is that for every bull who says the bottom's in, there's a bear who says it isn't and that we could sell off much further. So who do you trust and what do you do if you don't know if the market has actually bottomed? Throughout 2022 so far, the S&P 500 has sold off pretty substantially, actually exceeding 20% at one point, which constitutes it being what's called a bear market. And you can see that the S&P reached a very pivotal moment here on May 20th, where it hit a bottom and then bounced substantially off of that bottom. In fact, if you look at that red candlestick, you can see that the bottom base of the candlestick is where the market closed. And the wick below it is how low it went that day. So it went down really hard, bounced suddenly, and then went up from there. And if you look in the past, you can see that prior bottoms, like the bottom of the pandemic sell-off in March of 2020, also did a similar thing. For example, here on March 23rd, 2020, the market sold off, hit that capitulation point, bounced, went higher, and never tested the bottom. Unfortunately, if you're only looking in the charts and you see that it does that kind of movement, it's not a guarantee that a bottom is in. And here's where the bears have an edge. For example, when we look back at the market sell-off in 2018, you can see that it looked like it bottomed on October 29th, 2018. And with the S&P 500 down more than 10%, that's a perfectly reasonable correction and a perfectly reasonable belief that it may have bottomed at that point was going to head higher. But take a look at what happened after October. The market didn't truly bottom in 2018 until December 26, where you can see that it hit a bottom point and bounced. And unfortunately, unlike previous bottoms that had that significant extreme capitulation point, there wasn't anything quite like that in 2018. To make matters worse, from October 29th to December 26th, the S&P 500 sold off an additional 9.87%, exceeding once again the 20% mark that made it a bear market. So if you'd gone all in on October 29th, not only would you be down an additional 9.87%, you would have missed out on that buying opportunity to get in at even lower levels. Of course, no one knew for sure if that was the bottom, but as time went on, it was proven out that that was the bottom and that the market was just going to continue heading higher from there. And if we go back further in the past, you can see very similar of these double bottom issues happening then too. If we look back at 2011, the actual bottom was on October 4th. And although it looked like the market had bottomed in August of 2011, it did sell off an additional 2.43% from that bottom in August to the actual bottom on October 4th. In more extreme cases, this can mean a very significant difference between the false bottom initially and the extra bottom that comes later. For example, when we were selling off in the great financial crisis of 2008 to 2009, it looked like the market had bottomed on November 20th of 2008. And although the market did bounce from that point, it ended up selling off an additional 10.83% before the real market bottom happened on March 6th of 2009. So going back to May of 2022, the question everybody's asking is, are we at a bottom? We've sold off 20%, so it looks a lot like it did in 2018. However, the pandemic sell-off was more than 35%, and during the great financial crisis in 2008 and 2009, we sold off more than 50%. So there could be a lot of downside from here, but this could also be the bottom. So what's a long-term investor to do? If you've been watching my channel for a while, you know one of my key rules is that I'm never right. I never try to predict which way the market's going to go. For me, there's no benefit to it. There's tons of people who try to predict it, and they're always wrong. Sometimes they'll get it right, sure, but you could try and guess how much candy's in a jar. You might get it right, but that doesn't mean you actually can do it again. There are so many different variables that go into a market movement that there's no real accurate way to be consistently right about which way a market's going to go. So rather than try to predict which way the market's going to go, I just have a plan for both directions. What am I going to do if the market heads higher, and what am I going to do if the market heads lower? If you're a long-term investor and you don't want to spend any time looking at the chart charts, you just want to set it and forget it, the best way to do it is something called dollar cost averaging. What this means is you decide for yourself how much money you want to put in every week or every month, and then you just do it on the same day every week and every month, regardless of whether the stock market, the asset, the crypto, or whatever you're buying is up or down on that day. By doing this, sure, sometimes you're going to get in at the higher prices, but also sometimes you're going to get in at lower prices. So the idea is that over time, you're going to build up a significant position, and if you have a 20-year or longer time horizon, the more you have, the more it's going to go up, and all of these market fluctuations that happen over the short term aren't going to matter if you have that long-term time horizon. However, if you want to invest a little bit more time into how you're going to make your investments, and you're going to try and get as low as you possibly can when it comes to buying in stages, that's what I do. And the way I do it is by looking at a chart and seeing where a stock or an asset like the market actually found support in the past. Of course, the next place it finds support is just my next buy. It's not my last buy. I always save cash on the sidelines to buy at lower levels so that if my asset sells off even more, I have the opportunity to buy at lower prices. So if you're talking about the S&P 500, its recent low was at $3,810.32. But you have to remember that support works kind of like a trampoline. Sometimes you'll hit it and you'll bounce really low into it, and sometimes you'll hit it and bounce off of it in a big way. So if you're feeling more aggressive, you aren't going to want to use the absolute low as your target. What I do is I switch to a shorter time frame. I like looking at the 15-minute time frame, and you can see that down here there's another point where it found support slightly above at $3,811. But even that support level is pretty conservative. If you really did want to build a position, let's say you don't have any money in the market at all, but you don't want to buy at its highs, you want for it to sell off a little bit, you can be a little bit more aggressive and use higher levels where it had found support in the past. For example, if you look back at this day, you can see that there were significant points of support here, and you might even use this day here at 38.77 as your first buy, and then even use 38.10 as your second buy, so that you're building up your position over time. Once again, how much you choose to buy in each purchase is entirely up to you. It's based on your risk profile, your time horizon, and how much money you have to put to work. For me, if you're talking about an index fund that's tracking the S&P 500, then I'm just regularly putting money into it. Sure, I do have investment portfolios where I have individual stocks, and I apply different strategies to each one of those individual stocks. When it comes to the market, I just want to put money in at good levels. If you feel like the market's bottom, then you probably don't want to wait for it to sell off that much. If you remember in the past, it didn't pull back that far, it didn't get that close to the bottom as it was moving its way up. So in that case, you might want to look at more recent support, like these levels here at 40.60, where you might want to start your position from there. Additionally, if the market never looks back and you're just starting your position now, you may want to continue buying up higher, even though that will raise your cost basis. If this is the bottom, you aren't going to get that opportunity again. However, let's say that that isn't the bottom. What would you do from there? Well, for me, I'd switch back to a longer time frame like the daily or even the weekly chart, and I'd look in the past to find additional levels of support where the S&P 500 hit another bottom. At this level here at 37.23, you can see that we have another key capitulation point where it might find support if it sells off to that low. And it just keeps working from here. You can find that there's more key support down here at $3,556, followed by additional support down here around 32.68. Now you'll notice when I'm drawing the lines, sometimes I use the wick, but most of the time I use the base of the candles that we're looking at. And the reason for this is that the base of a candlestick often provides a lot more support than the wick. As I said earlier, you can see that it's kind of like bouncing through a trampoline. The stock market kind of hit this point, found support underneath it, and bounced higher, but the real level of support is probably around the 32.68 mark. Using this technique, you can go further and further back in the past to find price support levels that you might be able to make additional buys at, so that if you're regularly putting money into the market, that might be the way you would do it. For me, investing in an index fund requires me to be fluid. If the market really did find a bottom, I have no problem buying up at higher levels. However, if it didn't find a bottom there, I do want to have price levels at lower support areas where I'm going to add to my position and build it up over time. This is all about the long-term play. I'm going to be in it for more than 20 years, so I'm going to be constantly adding to it. To learn more about long-term investing, check out my videos here. Thank you for watching, and I'll see you in the next video.